Greek bonds have been on the rise as lawmakers debate a new set of austerity measures. Many investors think that the package will be passed tomorrow, giving Greece access to the fifth installment of a $157 billion rescue plan. Now, yields on Spanish and Portuguese 10-year bonds also fell today. Here with more on the bond outlook for the next half of the year is Jim Caron. He's the global head of interest rate strategy at Morgan Stanley. And welcome to In Business, Jim.
Thank you.
$35 billion worth of 5-year notes hitting the market here in the United States today. What appetite do you expect to see?
Well, I think for the 5-year point, the appetite might be okay, particularly given since the price action has seen Treasury bonds cheapen up over the past couple of days. And I think we're at a level that probably makes a little bit of sense for investors to buy. Certainly yesterday's 2-year note auction did not go so well. It tailed a little bit, but I think the concession that's in the market right now will be enough to make the 5-year note sale go very well.
Now, what's the driver of that? Because we're talking about these promising headlines out of Europe, but there is a tremendous amount of uncertainty that's still there. I mean, is the U.S. just the beneficiary of European uncertainty?
Well, that's exactly right. I think that most of it is true, but there also has been a soft patch of economic data, which has also contributed to the decline in yield. So really, it's a perfect storm. We have uncertainty in Europe, plus we have a soft patch of economic data that's come through. Both have contributed to pushing yields lower. But right now, what we're seeing is that the market's starting to price, maybe slightly better news coming out of the Greek vote tomorrow. And we're seeing some of the heat being taken off the Treasury market, and that's causing some of the sell-off today. And equities are certainly reacting to that as well.
Jim, is it that clear that we get that vote out of Greece tomorrow and that sort of clears out the way? Or do we need to see the Germans officially sign on with the French and get that clarity in terms of whether they're going to extend maturities for the balance of Greek debt on balance sheets?
Well, I mean, look, I think we're far away from a resolution that answers all those questions, but certainly I think we need to take it step by step. So, step one is, what the French came out with yesterday, and step two is what the what the Germans have reinforced and what the French message was. And then from there, we just take it step by step. I think we're a long way away from a solution. As a result, the U.S. Treasury market is going to continue to, bounce around within a range until it gets the answers.
Well, this is the same week that we're, waiting for the Federal Reserve to exit its support from the market by no longer buying that $600 billion worth of U.S. debt. Who becomes the buyer? Who remains the buyer?
Well, I think we have to look at who stepped away from the Treasury market first. So we've seen a lot of foreigners step away from the Treasury market as the Fed has been buying Treasuries. We think those purchases come back. We also think that, and this is where we differ a bit from some other forecasters, is that we think that real rates are going to start to rise starting with the end of QE2. So 10-year real rates, which is the nominal yield less inflation, is only about 60 basis points right now. So we think those rates rise. It makes evaluations for bonds better, which means that it should attract more buyers going forward. So, there are many people who are vocal at being short treasuries that are underweight liquidity in treasury product, and we think there's ample room for those people to step up and buy as a real component of their returns start to increase going forward.
Yeah, Jim, you just referenced some of the softer economic data we've seen in this country of late. Morgan Stanley is projecting that we're going to see growth in the second half of the year, specifically led by the auto sector. I mean, today we get a consumer confidence number that really sort of undercuts, some could say, the belief that the consumer can come in here and really support the U.S. economy.
Well, I think today's data is just a reflection of the past. And really what we're looking at and what we think some of the catalysts will be for better economic growth is really looking into the future. And looking at the third quarter, we expect there to be a rebound in the auto sector, which could contribute 1.5% to GDP in the third quarter alone. In the fourth quarter, could add as much of a 0.5 percentage point to GDP. So we think there's a significant tailwind in terms of growth that's coming in front of us, and we think the Treasury market will react in kind to that.
All right, Jim Caron, Morgan Stanley, thanks for joining us today.